If the US were to enter a major recession, the ripples would be felt worldwide. But did you know there are 10 countries that could face devastating consequences, potentially even falling apart? Stay tuned to find out which nations are most at risk and why. The United States is the largest economy in the world, and its financial health is deeply interconnected with the global economy. A recession in the US could trigger a domino effect, impacting trade, remittances, and global stability. Today, we're counting down the 10 countries most vulnerable to such a crisis. These nations are highly dependent on US trade, aid, or financial stability, and a US recession could spell disaster for them.
Let's dive in. Number 10.
Mexico, the US's largest trading partner, heavily relies on its northern neighbor for economic stability. With over 80% of its exports directed to the US, Mexico's economy thrives on manufacturing and agriculture. Industries like automobiles, electronics, and textiles dominate the export market. Additionally, remittances from Mexican workers in the US contribute billions annually to local economies. Tourism is another vital sector, with many American visitors fueling Mexico's economy. A recession in the US could significantly reduce demand for Mexican exports, causing unemployment. Shrinking remittances would also strain families relying on this income. Mexico's oil exports, while significant, are highly price-sensitive to global economic trends. Inflation and currency devaluation could follow a U.S. economic downturn. Social unrest could arise from rising economic pressures. Moreover, foreign investments may dwindle due to global market uncertainty. Mexico's resilience would be tested in its ability to stabilize internal economic systems. The government would need to implement measures to shield vulnerable sectors. Trade diversification could be an essential strategy moving forward.
Number 9.
Canada's economy is closely tied to that of the United States, making it highly susceptible to economic downturns. Over 75% of Canadian exports, including oil, timber, and automotive parts, go to the U.S. As a major energy supplier, Canada benefits from U.S. demand for crude oil and natural gas. A slowdown in American economic activity could reduce this demand, leading to revenue losses. Additionally, Canada's manufacturing sector, reliant on U.S. consumers, could see significant job cuts. Cross-border tourism, an essential revenue stream for many provinces, might also take a hit. A U.S. recession could lead to a drop in American investments in Canadian businesses. Housing markets in cities like Toronto and Vancouver could face declining foreign investments. Canada's financial stability, built on its close trade ties, would be challenged. The agricultural sector, exporting grains and livestock, could see reduced profits. A weaker Canadian dollar might partially offset export losses but could increase import costs. Federal and provincial governments would need to implement stimulus measures. Diversifying trade relationships with Europe and Asia could be a viable long-term strategy. However, short-term challenges would require resilient economic policies.
Number 8.
China, the world's second-largest economy, maintains strong trade ties with the United States. A significant portion of its exports, including electronics, textiles, and machinery, heads to American consumers. The U.S. is also a major investor in Chinese industries and technologies. A recession in the U.S. could reduce demand for Chinese goods, disrupting its export-driven economy. This slowdown would ripple across Chinese manufacturing hubs, leading to potential job losses. Additionally, U.S. companies might delay or cancel investments in Chinese projects during an economic downturn. The global supply chain, deeply intertwined with China, could face disruptions, further affecting its economy. The yuan's stability might be tested as global markets become volatile. China's trade surplus with the U.S., a cornerstone of its financial system, would shrink. Domestic consumption, already under pressure, might not compensate for reduced exports. China's ambitious infrastructure projects could face funding challenges as revenues decline. Social unrest could emerge from growing economic disparities and unemployment. The Chinese government might intensify trade diversification and focus on regional markets. Investments in high-tech industries and domestic innovation could become more critical for resilience.
Number 7.
India, a fast-growing economy, relies on the U.S. for trade, remittances, and investments. The U.S. is one of India's top export destinations, particularly for IT services, pharmaceuticals, and textiles. A recession could significantly reduce outsourcing contracts for India's IT sector, a primary revenue source. Remittances from Indian workers in the U.S., which form a substantial part of rural incomes, may also decline. Furthermore, foreign direct investments, FDIs in India, particularly in tech and infrastructure, could slow down. Reduced demand for exports like jewelry and machinery would impact manufacturing hubs. The tourism industry might face fewer American visitors, affecting revenue. Domestic inflation could rise due to a weakened rupee and higher import costs. India's dependence on oil imports would further strain the economy amidst global instability. Unemployment might rise, especially in export-oriented industries. Social programs could face funding challenges as the government reallocates resources. However, India could use the opportunity to expand trade within Asia and Europe. Strengthening its internal market and promoting local manufacturing might mitigate external risks. Investments in renewable energy and self-reliance initiatives could boost long-term stability. Number 6. Japan, a leading global economy, has deep trade connections with the United States. The U.S. is a key market for Japanese automobiles, electronics, and machinery. A U.S. recession could drastically reduce demand for these exports, impacting Japan's GDP. Japanese companies heavily invested in the U.S., such as Toyota and Sony, might face reduced profits. The yen could strengthen as investors seek safe haven assets, making Japanese exports less competitive. Japan's reliance on imported energy could exacerbate economic pressures due to rising costs. Tourism, an important sector with many American visitors, could also decline. The aging population and labor shortages might intensify the economic slowdown. Financial markets in Japan could experience volatility due to reduced global confidence. Japan's reliance on trade surpluses to maintain economic stability would face challenges. Domestic consumption might rise marginally but wouldn't offset export losses. The government could focus on stimulating local industries and diversifying trade partners. Expanding ties with Southeast Asia and Europe could provide new growth opportunities. Investments in advanced technologies and innovation would be essential for recovery. Japan's resilience lies in its ability to adapt to shifting global dynamics.
Number 5.
The Philippines relies heavily on its relationship with the United States for economic stability. Remittances from overseas Filipino workers, WFWs, contribute significantly, with a large portion coming from the U.S. These funds are a lifeline for millions of Filipino families, supporting education, healthcare, and daily expenses. The Philippines is also a key outsourcing hub for American companies, with its BPO sector generating billions in revenue. A U.S. recession could lead to fewer job opportunities for FWs and reduced outsourcing contracts. This would impact the country's GDP and unemployment rates. American tourists, who form a significant portion of the country's visitors, might decrease in numbers, affecting the tourism industry. Investments in infrastructure projects could slow down as foreign investors tighten budgets. The peso could weaken against the dollar, raising the cost of imports like oil and machinery. The government would face challenges in funding social programs due to reduced revenues. Inflation could rise, further burdening ordinary Filipinos. Strengthening trade relations within Asia could help mitigate some of these risks. Encouraging domestic consumption and supporting local industries might boost internal resilience. Diversifying remittance sources and exploring new markets could ensure long-term stability.
Number 4.
Germany, Europe's largest economy, heavily depends on exports, particularly to the U.S. The automotive industry, featuring brands like BMW and Volkswagen, is a significant contributor. A U.S. recession could reduce demand for German vehicles and machinery, affecting key industries. The energy sector, already under strain, might face increased challenges due to reduced investments. American companies might cut back on imports of German precision equipment, impacting its industrial base. The financial sector, deeply connected to global markets, could face instability. Tourism, reliant on American visitors, might see a notable decline. Germany's reliance on energy imports could lead to higher production costs during global turbulence. Small and medium enterprises, often export-oriented, would bear the brunt of reduced demand. The Eurozone's economic leader might need to support struggling EU neighbors, straining resources. Diversifying trade relationships with Asia and Latin America could be a crucial strategy. Investments in green technology and digital transformation might offer new growth avenues. The government would likely implement stimulus packages to support critical industries. Germany's strong economic foundations would be tested, requiring innovative solutions for recovery.
Number 3.
Saudi Arabia, a major oil exporting nation, is deeply linked to global energy markets, including the U.S. A U.S. recession could significantly reduce oil demand, slashing revenues for the kingdom. The government's Vision 2030, aimed at diversifying the economy, could face setbacks due to reduced funding. Lower oil prices would impact public spending on infrastructure and social programs. Foreign investments in Saudi projects, including NEWEM City, might slow down during economic uncertainty. The U.S. is also a key security partner, and shifting alliances could add geopolitical risks. Domestic economic diversification efforts would need accelerated reforms to maintain stability. Reduced oil exports could lead to unemployment in related sectors. Inflation might rise as imports become costlier amidst currency fluctuations. Social unrest could grow if economic benefits fail to reach the broader population. Tourism plans, such as religious tourism, might be less affected but still face challenges. Saudi Arabia could deepen ties with Asian economies to offset losses from the U.S. market. Expanding renewable energy initiatives might help reduce oil dependency. The country's long-term economic stability would hinge on strategic reforms and innovation.
Number 2.
Brazil, South America's largest economy, has strong trade ties with the United States. The agricultural sector, a cornerstone of Brazil's economy, heavily depends on American markets for soybeans, beef, and coffee exports. A U.S. recession could lower demand for these goods, impacting rural economies. Additionally, Brazil's energy sector, which exports ethanol and oil, could face reduced revenues. American investments in Brazil's infrastructure and industries might slow down, affecting growth. Unemployment could rise in export-dependent industries, exacerbating income inequality. The real, Brazil's currency, might weaken, increasing import costs and inflation. Deforestation in the Amazon, driven by global trade, might slow due to reduced demand. Domestic consumption might partially offset export losses but wouldn't suffice. Tourism revenue could decline as fewer American travelers visit Brazil. Social unrest might grow in urban centers due to rising economic disparities. Strengthening regional trade within South America could mitigate some losses. Diversifying exports to Asia and Europe might provide long-term stability. Brazil's economic resilience would depend on effective government policies and international partnerships.
Number 1.
South Korea, an export-driven economy, relies heavily on the U.S. for trade and technology. Key industries like electronics, semiconductors, and automobiles depend on American markets. A U.S. recession could drastically reduce demand for South Korean products, hitting GDP growth. Companies like Samsung and Hyundai, which dominate global markets, might see reduced profits. The South Korean won could weaken, increasing costs for imported raw materials. Financial markets in South Korea could experience volatility due to global uncertainty. The tourism sector, popular with American visitors, might also see a decline. Unemployment could rise in export-reliant industries, impacting social stability. The government would likely implement measures to stimulate domestic consumption. Strengthening trade ties with Southeast Asia and Europe could offset some losses. Investments in cutting-edge technologies like AI and green energy might boost resilience. The country's reliance on innovation and R&D would be critical for recovery. Social policies might need adjustments to support vulnerable populations. South Korea's ability to navigate these challenges would test its economic leadership in Asia. As we've seen, a U.S. recession wouldn't just affect its own borders, it would send shockwaves across the world. From trade and remittances to investments and oil prices, these 10 countries could face major challenges, potentially altering their economic and political landscapes. What do you think? Could these nations withstand the storm? Let us know in the comments below. And don't forget to like, share, and subscribe for more deep dives into global economics.